everyone. Welcome or welcome back to the Lens. We are finally back after a well-deserved few weeks of vacation. We have the guys back together. We have Kirk Shapiro and Larry McDonald from the Bird Shops Report. We miss you a lot, and I know you missed us too. I've been seeing your comments on Twitter and on LinkedIn, so we're here for you. Remember, we have a live institutional chat on Bloomberg. We started that chat back in 2010. Right now, we have more than 650 investors all around the world with more than 130 contributors in more than 21 countries. But today we're going to discuss everything that's been going on for the past few weeks and everything that we're seeing, for the next couple of days. So, Larry, Craig, you have the stage. Go ahead.
Thank you, Valentina, and thank you, the whole team in New York. Really appreciate you. I'm in Soho today, and it's been a good week in New York. Did Tom Keene this morning. Special thanks to Tom and Bloomberg Surveillance and Maria Bartiromo this week. So we're getting a lot done. Hosting a client lunch at 1:30 today in the West Village. So it's good to be back in New York. I miss my buddy Craig Shapiro. Craig, thanks for being with us. Craig's running the Discord room and help obviously with our Bloomberg chat. So we've got the Bloomberg chat for people that are on Bloomberg. The Discord room is for family offices and financial advisors and high net worth individuals that are not on Bloomberg. Craig's been running that show. We're gathering intelligence. That's the whole key, is working with some of the best investors in the world, gathering that intelligence real time. Craig, one of the things people have been talking about this week is when you have claims that are breaking out, jobless claims, and then you have the tertiary financials breaking down, so your credit acceptance, your upstarts of the world, they face, the subprime crowd. Uh, it's not like pounding the table bearish, but it's a classic like leading indicator that the fact that they're both happening at the same time, right? You got a weak jobs number last week, you got claims breaking out this week on continuing claims, and you have the tertiary financials breaking down as well. What are you hearing from some of your top institutional clients, Craig?
Yeah, and the other thing I would add to that, which I think goes in concert, is credit spreads. I know you've been talking about that as well all week. Just credit spreads, the tightening of spreads, just hasn't kept pace with the underlying move in equity indices. And I think what we're seeing, it's what we've been talking about all year, is this K-shaped economy where the upper echelon, the wealthy, cash-rich companies, anything exposed to AI and the tech chain and the build out of infrastructure is doing incredibly well. And then the lower part of the K, low end consumer, struggling with real wage growth momentum not keeping pace, inflation staying sticky, and now employment indicators starting to roll over. And so we have this bifurcated economy, and the things that you would expect to struggle as the economy slows are showing more and more evidence of that. It's not showing up, as you mentioned, in the overall indices yet because money flows into stocks have been good. We haven't seen a tremendous amount of layoffs yet, so 401k contributions are staying relatively strong. Systematic flows have been very robust as volatility has come down because the administration continues to sell vol. So it's not showing up everywhere, but under the hood, I think we've been noticing a lot of those leading indicators of slowness. And look, we're in August. This August, September, October period historically has been very constructive for volatility. And we've seen some of the larger corrections. We've seen some of the larger corrections during this time period over the last several years. So I think that our caution flag has been raised. And I think a lot of our clients are seeing similar things, but people are still feeling pretty good about the equity market and the NASDAQ and making new all-time highs. So there's that bifurcation.
Yeah, so we had the most trade alert buys in the history of the Bear Traps report in April and May of this year. We're backing up the truck on energy infrastructure, the what we call the NUKZ type names, NUKZ. And so and same thing last August. We want to sit in the boat and wait for those high conviction moments to put money to work. Craig, I think literally on the street, you're probably one of the best people to talk to about this in terms of leading indicators on the RRP. So the reverse repo facility, you're an expert in this area. it's a good measure of liquidity, and I think why it's so important for people watching us right now. Everyone knows that during the Yellen days, the Biden team was able to use that huge RRP for excess liquidity. You've been mentioning, and you've been talking to clients in the chat this week on the institutional side, that the RRP level's coming down, and so walk us through, like, don't we need the stable coin situation and money funds to try to like offset this? When, like, if the RRP comes down too much, when does that start spilling over to liquidity in the market?
Yeah. So, basically what happened was we had this massive amount of money printing. It was sterilized by the RRP facility. So, tremendous trillions of dollars went into this facility that was able to earn, Fed funds plus 5 basis points from the Fed, free money for a long period of time. So, what Yellen was able to do after her debt ceiling saga was lifted is when she restocked the Treasury General account and issued an inordinate amount of bills, she was able to
Okay,
draw.
so let's just walk everybody through.
Yeah.
So it's the Treasury
The
issues
Treasury
T-bills.
when the government operates under a debt ceiling constraint, they cannot issue net new debt. So the cash from the Treasury gets run down. Once the debt ceiling is lifted, then Treasury goes and restocks the general account. Yellen took it back up to $1 trillion. Besson, and then Besson's talking about $850 billion right now. We're in the $400 billion.
But bottom line is, Bess is trying to do the same thing.
Well,
I just
that's right. So he is basically going to restock the Treasury General account. The reason you do that is because Treasury needs that cash to pay its bills. It also needs about 7 days of working capital. God forbid we have a market interruption like 9/11 where the government can't raise debt for a technical reason. There's cash on hand to pay back bills, right? That's the genesis of why we run such a large amount of cash in the Treasury General account. There's been a rule about 5-7 days of cash is needed. That gets you about $850 billion. Besson has said he is going to restock to that level. So he's being consistent with Yellen. But by doing that, the money is actually being pulled from somewhere. It's being pulled out of assets that could be invested in other places. What Yellen was able to do is she was able to take that money very easily from the reverse repo facility because there were trillions of dollars in there.
So, and how does that work, Craig? So if the RRP's yielding this much and T-bills are yielding this much, then people would just rather.
Yeah, they'd rather just own. They may just rather own T-bills because T-bills are pristine collateral. You can rehypothecate T-bills. You can leverage up T-bills, and as long as the yields are fairly comparable, which they generally are, money can much more easily move into T-bills. T-bills are 4 weeks, 8 weeks, 12 weeks, where the RRP is daily, right? So every day you have to make a decision with the RRP. So,
so there was like $2 trillion in the RRP, and that money all that juicy money just moved over to T-bills. But right now, it's not the case. So if you're Bessent now, how's he and he has to refill, like you said, he has to refill the Treasury General account because now it's the time they have to do it after they raise the debt ceiling. So where's this money going to come from if he doesn't have that juicy RRP?
That's correct. So there's about $78 billion left in the RRP. So he's got a little bit of room there, but not a tremendous amount.
And she had $2 trillion in there.
Right? So the plug is bank reserves, right? So that's where the money is going to come from. There's $3.3 trillion or so of bank reserves out there. And so the money that will go to fund the Treasury over the course of the next 2 months to raise the general account back up to 800 billion, 850 billion is going to come out of bank reserves. And the question is, how much money will come out of reserves before there is some strain in the overall banking system, or with overall, certain types of banks or smaller banks that have less liquidity, as money is pulled out of these out of checking or savings or money market accounts at these smaller banks and go into T-bills, there could be liquidity strain. So I suspect over the course of the next couple of months, we're going to see the standing repo facility probably get used. That's another area where we could find demand. I think that's more likely than, this idea about stable coins, I think is, there's a lot of back and forth on. I think this is more of a gradual thing over
time.
Right.
It's going to take a long time for those stable coins to really be factors in the market, right?
That's right. And look, and it's really, if you a stable coin buyer is really someone who already is selling something else in order to buy the stable coin. So it's not clear that that's really net new treasury demand. It's just trying to take market share from other assets, right? So I suspect over the next couple of months, we're going to see bank reserves come under pressure, particularly into the end of a month or the end of the quarter. That's where we'll get to see some of the liquidity strains, SOFR rates move up. That's when we get those stress periods. Are they enough to scare anybody? They haven't been so far. But Besson has a lot of debt to sell between now and the end of the year, as he was unable to do so until the debt ceiling was lifted. So I think on the margin that's some additional strain that will come into markets. That's liquidity leaving the markets. And then when we need more liquidity, when we see a slowing economy, those are the types of things that could maybe trip up investors and increase the probability that some of these data releases that come out that go the wrong way, or if the Fed isn't as dovish as people think, can actually lead to a more protracted, heavy, sell-off.
And so you see this chart here. One of the things that over the years we really track is like when you go 75 trading days without a real 1% move in the market. That's important, and that's just what just happened. We went like 75 trading days without really much of a move at all each day, right? There was a very, like the actual rate of change in the market each day for about 75 days was very, very calm. And now in the last week, we've had a couple of what we call bear hammers there. You can see in that top right corner, and just looking at Bank of America, for example. But we've had two very large bear hammers, and all that means is the market has had a kind of either a new high or a local high, and then reverses during the day, and that move as a whole during the day. Last week we had, I think, a 1.5% move, bear reversal, and then yesterday we had a pretty nasty one as well. A nice bounce today. The bottom line is Craig, when you go long periods of time with real tranquil seas, and then you have that kind of intraday bear hammer, 2 or 3 of those inside of a week, that's a sign that something has changed. In my view, like something has changed. The market's looking at something in a little different way, because we went 75 days or so without any kind of intraday volatility like that. What are you seeing in terms of intraday volatility in the last 10 days versus the last 75 days? How are you looking at that?
Yeah. No, I mean, I agree. I mean, we basically had this vol suppression that has taken place post, call it the third week of April, right? When the government and the administration tacoed on tariffs and really pivoted and had gotten concerned about the bond market and the equity market, and really placated market fears and said, you know what, we're not going to go as crazy. We've seen a large suppression of volatility everywhere. Equity volatility, fixed income volatility, FX volatility has just gotten obliterated, and the administration has really pushed on that. We had originally thought, because the administration had been talking about this transition period, a detox period, and maybe seeing a growth slowdown. Well, they have transitioned to let's run it hot, right? And so as they've done that, they've debased the dollar further and more volatility suppression. And so we kind of got to a crescendo, really, I'd say, 2 weeks ago, kind of into the lead up to the Fed meeting and the lead up to the big tech earnings, where volatility really was just kind of on the floor. But subsequent to that, and particularly last week with the TGA, the QRA meeting, the Fed meeting, the big tech earnings, we've seen a little bit of volatility coming back in. And I think on Friday last week, when we saw the payrolls numbers finally come out with a massive negative revision, people have started to wake up to say, wait a minute, maybe the economy isn't as robust as we think.
And Stephen Moore said this morning that it was like 1.5 million jobs overstated. That's what the White House is saying. 1.5 million jobs over the last year overstated in the jobs numbers, according to Stephen Moore in the White House.
That's right. So, and we saw that in the revisions, and we obviously saw that with Trump firing the head of the BLS. And I think it just kind of reminded people that the impact from tariffs and the decision on tariffs is going to have a real impact. And maybe we haven't seen it yet because of all the pre-buying and the delays, but it is starting to show up in the real economy. The other thing that's showing up is immigration reform, and the lack of people coming into the country has also kept the labor market from, not really seeing the job growth momentum. And so as investors now are picking up to this reality and saying, wait a minute, we thought the Fed was going to cut rates because inflation was under control. Now we've opened up the door to, well, maybe the Fed is being too tight. They haven't cut rates enough or not going to cut rates quickly enough because the economy actually is slowing more rapidly. And I think that is something that investors have been dealing with this week. And that's why I think volatility is starting to evince itself. And we're seeing that again.
And Jose, if you could put that last chart up. So to your point, Craig, where would that show up? Subprime lenders, credit acceptance. They're basically one of the largest subprime players. So if the economy is softening, it's going to show up in triple C's. That's the junk of the junk in high yield. It's going to show up in places like credit acceptance, right? You see how, look at that big move lower relative to the market, relative to larger financials like Capital One. That's where that weakness is going to show up first.
Yeah, I mean, these are the fringes, right? And look, I mean, something like the most short index, Goldman has the most short basket, UBS has the most short basket. I think these baskets have been up, over 100%, right, from the lows in April. But over the course of the last 10 days, they've started to chop around. They started to get weak. The UBS has a meme index. Similarly, these are the areas where people kind of go to last to get the last bit of juice out of the equity market. And so that's kind of a LIFO situation, last in, first out on the risk exposure there. We start to see these tertiary assets come under some pressure. These are the areas that you would expect to see if the move is not broadening out because people are becoming a little bit more concerned. And maybe the economy is going to go through a slower patch before we get a reacceleration based on AI CapEx and the tax cuts and one big beautiful bill, which is what people were thinking for 2026. So I think we're in the teeth of that right now. And seasonally, this August to October period kind of lends itself to a little more fear, a little more concern about where things might be headed. You're good. Cameras. Well, we lost Larry there for a second. Not sure if we're going to get him back, but I think from here, the most interesting thing that I see and what I think is going to be potentially market moving as we move into the back half of August. The next date, I was going to say, Larry, the next big data point that we have coming up is CPI, and that's next Tuesday. And I think that's where we'll get potential for a major move from here, right? If we have another benign CPI print, it will clearly cement the rate cutting cycle beginning in September. We'll obviously have more support for that. The market's already pricing that in, but this will basically cement it home. And I think equity markets will be very happy with that. It's say, look, the Fed's got our back. Disinflationary momentum is entrenched. Things are good. That's going to continue to be risk on bullish. However, if we got a hot CPI print next week, I think it would throw some cold water on this momentum on rate cuts, because it would say, look, the Fed would say, or Powell would say, this is what we've been worried about. We've been concerned that tariffs were going to be inflationary, even if it was transitory. But there's still going to be upward price momentum.
Yeah, but
in the goods sector, and so that would make it harder for them to rapidly provide accommodation into a potentially slowing economy.
Craig, ISM prices paid, when the rate of change is that violent, and we have a chart that's up on X, but ISM prices paid, when that rate of change is that violent up, that's already telling you that there's a high probability of a CPI move to the upside, because the rate of it's not like some people say, well, prices paid are not CPI. Yeah, I get that. A 5-year-old gets that. But when the rate of change is that violent, we've never, ever in the history of markets seen meaningful rate cuts when prices paid on ISM is moving like that vertical that fast.
Yeah. Look, I agree. I mean, right now, the market is looking for a CPI print next week of 2.8% year on year, and the core at 3%. Right? If you have those numbers beat and you get 3.1 or 3.2% on core CPI, and then the PPI the next day also with a 3 handle. It's going to be very difficult for Powell to come out either at Jackson Hole in September and say, you know what, screw it. It's time to cut, right? He's going to continue to go with the messaging of, see, we told you so. We told you inflation was not slayed. And that means we can't cut. And look, and the reason the labor market is slowing is because of tariffs, because business uncertainty, and it's not cost of cap. So this is the dynamic that we could find ourselves into a seasonally stronger period for volatility that maybe opens the door for some weakness, for risk, and that confirms what the tertiary assets and what credit is already starting to leak out. So I think we do have some risk to that next week.
Craig, on that, you mentioned, so we look at all these tertiary verticals. We have a model that looks like 12 different verticals, 12 to 15. One of them is, say, market cap equities more than 10 billion with no sales, for example, or Solana versus Bitcoin, or ARK stocks versus the Qs. But one of the things you've been tracking is the most shorted stocks and then the IPOs, right? The hot IPOs, we had 2 hot ones yesterday and then a big reversal today.
Yeah, Fly and Wi-Fi were 2 IPOs that were well received yesterday. Big over demand, priced well, and then today both of them are down 10-15%, right? So I mean, lack of sponsorship on day 2. They don't fit in an index, and so they don't benefit from the passive money. So once the degenerates leave on day 1, this is where the real support is. It's not really there, right? And so look, passive money continues to support the equity market. 401k inflows are constructive. Share buybacks remain constructive. So those are those positive flows that continue to come in. But fundamental players are seeing outflows, are seeing some risk, and so they're not going to go and necessarily sponsor some of these new issues. And so, that's what I think you would expect to see at a potential turning point in the tape. But again, I think we need to see the data. We would need to see continuation of slowing on the labor market and a potentially stickier inflation print. And I think that could bring some risk to trading, from the middle of next week and beyond.
Well, Craig, I got to get off to the lunch, but I'm really happy. We had an incredible week. How to listen when markets speak. Incredible week number 3 on Amazon across many of the financial categories, and A Colossal Failure of Common Sense is also been in the top 40 books. So we've got 2 books in the top 40 on Amazon. Thanks everybody for all the support. Craig, have a great weekend with the family. Any closing comments? But I gotta just hop out into this next meeting.
No, it sounds good. I think we're in the summer doldrums here, but there is some important data coming up that people need to keep an eye on, and markets are a little bit overstretched going into it. So, and volatility is low. So head on a swivel like always.
Yeah, the best month for the year by far for the VIX is that old August, right? So, which a lot of people think it's October, but it's actually the best month the last 15 years has been August. But thanks, Craig. All the best to the team in New York. I'm heading over to the West Village for the Ideas Lunch. Craig, look forward to seeing you soon, and all the best, my friend.
Sounds good. Take care, Larry. Thank you.
Thanks.
Thanks, Craig. Thanks, Larry, for such an insightful conversation. Thanks, everybody, for joining us today. Remember, guys, we have a lot of different products tailored just for you. Our goal at the Bird Shops Report is to democratize information. So right now we have the Washington pressure points, the Discord, we have the One Idea, we have our turning point, and we have our Bloomberg live chat. If you're interested in any of the reports or any of the services that we mentioned all throughout this video, remember to reach out to info@thebirdshopsreport.com and you can get all the information, sample reports just for you. And also remember to get your copy of How to Listen When Markets Speak now on Amazon. Thank you very much, and we'll see you next week. Bye.